How's everyone doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. Today, we're going to be looking at a couple of articles from Bank Director that really pose the question, should banks be chasing loan growth right now? And so I wanted to bring these in and show these to everybody and go through them. So the first one that we're going to look at is rising bankruptcies are a warning sign for banks. So there is a strong correlation between rising business bankruptcy filings and commercial loan write-offs. So after examining bankruptcy filings and commercial loan losses at banks for more than a decade, it's safe to say that financial institutions should be preparing for a worsening of credit quality. The research team at Janney Montgomery Scott examined quarterly credit statistics at banks with $2 billion to $50 billion in assets from the first quarter of 2007 to the first quarter of this year. This included looking at owner-occupied and non-owner-occupied commercial real estate and commercial and industrial loans with operating cash flow as collateral. When we matched that up with business bankruptcy filings, overall, the credit metrics remained fairly strong. The average C&I loss rate for the first quarter of 2025 was just 0.50%, down from 0.69% in 2024. Overall, this figure averages 0.58% since 2007. So the CRE charge-off rate was also quite low at an average of 0.11% for non-owner occupied properties. Since 2007, CRA loss rate averages just 0.11%. Now, just so people understand, that is very, very minuscule loss rate. So in other words, I would say like around an average loss rate would be probably about 1%. So if you're below 1%, your bank is doing pretty good. If you're below 0.50%, you're doing really good. And obviously a loss rate of just 0.11% means you have very scant losses, which is fantastic. So, but we continue on here. But perhaps most importantly, this research found that there was a strong correlation between CRE and C&I loss rates and business bankruptcy filings. Essentially, one variable, in this case, business bankruptcies, are influencing a second variable, loan charge-offs. So we found that roughly 90% of the time, business bankruptcy filings meant an increase in owner-occupied commercial real estate write-offs. We found similar results for non-owner occupied commercial real estate loans, though there was a moderately lower relationship between these two variables over the past 5 years. And the correlation between C&I loans and bankruptcy filings was lower during the 2007 and 08 financial crisis and from 2012 to 2019. So during the early 2000s, bankruptcy filings were over 1 million each year and bottomed near 620,000 in 2006, then jumped to 1.6 million in 2010, staying above 1 million until 2015, when the new normal was 800,000 per year. COVID-19 cut total bankruptcy filings down to 400,000, but now filings are trending upward back to 600,000 in 2025 and are likely to move up further next year. While these filings are a long way from the great financial crisis of 07-08, this incremental rise matters and should drive new C&I losses for banks. Our math suggests that another 15% in new bankruptcies should drive at least 12% more C&I losses in aggregate dollars. This is why investors and bankers should be aware of this important relationship analysis. So we conclude that rising bankruptcy filings should be a warning sign for higher commercial loan losses, even if the C&I relationship has proven weak in recent years. CRE loan write-offs, especially for owner-occupied property loans, have proven quite consistently to have a very strong relationship with bankruptcy filings, both business and total filings. So C&I loss rates do not vary as much, largely due to the underlying collateral. So C&I problems may exhibit a low frequency rate, and the C&I loss severity is significantly greater than commercial real estate when a loss occurs. So this is very interesting information here that we have on bankruptcy filings. And Janney Montgomery Scott did this analysis and basically came up and said, yeah, when we've looked at this, we do see some correlation here. And while loan loss rates and write-offs have been incredibly low and things have been very stable for banks over the last few years, it just says, hey, this should basically be like a flashing light, like a red light. Hey, keep in mind, what's going on. So this now that we kind of have this information and we've kind of set our base here for where the current delinquency rates are at, the charge-off rates are at, and we kind of have this flashing light around bankruptcies. Now we're going to take a look at our second article here, which is banks should not chase loan growth right now. So to prepare for the credit cycle turning, banks should price greater risk into their loan portfolios and consider rethinking their growth goals. So in other words, now this article is considering the credit cycle and basically saying that, hey, just asking the question, should you really be chasing growth at the moment? So let's get into this for a minute here. So bankers maintain that their borrower base remains healthy, and the U.S. economy has proven resilient in the face of uncertainty created by protectionist trade policies, with job gains in June exceeding economists' forecasts. However, credit quality continues to normalize as criticized loans are rising, while loan growth has fallen short of optimistic expectations earlier in the year. Criticized loans at U.S. public banks rose again in the first quarter, with the median ratio of criticized loans to Tier 1 capital climbing to 20.04%. from 18.52%. Banks classify loans as criticized if some sign of weakness emerges, but that migration does not necessarily suggest a future loss. Much of the weakness and concern in the investment community relates to commercial real estate loans. Some commercial real estate borrowers face a double whammy of low cash flows due to the rise of hybrid work and higher debt service stemming from increases in interest rates over the last few years. CRE delinquencies have risen for 10 consecutive quarters, but losses have often been less than many feared, in part due to well-funded distressed investors targeting the asset class. Like when banks have sold CRE loans, often in connection with an acquisition, sellers have recorded relatively modest discounts to par ranging from 8 to 10%. Consumer delinquencies have risen from historical lows as well. While many banks might not have sizable consumer or credit card portfolios, the consumer drives the economy. A weakened consumer could push the U.S. into recession. Currently, the American consumer is stretched. Savings rates have slowed, and excessive savings accumulated during the pandemic have been exhausted. But fortunately, the consumer is not yet broken. Loan growth has been a big disappointment, falling short of expectations that pro-growth policies and deregulation from the Trump administration would spur increased borrower demand. Uncertainty from tariffs that surfaced early in the second quarter seems to have weighed on borrowers' expectation plans. The Federal Reserve Board's H8 data shows that loans have grown 2.75% through the first half of the year, with stronger growth occurring in the first quarter. Notably, loans to non-depository financial institutions, including private credit firms that compete with banks, were by far the biggest drivers of growth in the first quarter. So now we have this nice chart here. So this says change in U.S. banks' loan balances in the first quarter of 25 from the fourth quarter of 2024. So we could see, ag loans are down slightly. Construction and land development loans are down slightly, but multifamily is up about 10%. Loans to NDFI, non-depository financial institutions, are up over 90%. Commercial real estate is up probably about 6%. Consumer lending is way down. Consumer lending is down over 60%. C&I loans are up about 10%, and 1 to 4 family is down just slightly, maybe about 2 or 3% there. But obviously, the NDFI, that has been the big driver here, because multifamily and C&I loans seen modest. Commercial real estate in general has been, modest growth rate of basically about 5 to 10%. So just very, very interesting here to see these numbers. So bankers will likely find that strong loan growth will be tough to come by, and it could be prudent to avoid pressuring lenders aggressively at this point in the cycle. Competition should remain fierce as credit is widely available to corporate borrowers through the high-yield leveraged loan and competitive private credit markets. Credit spreads widened when tariffs first surfaced in early April, but have since tightened back near record levels. Rather than fighting to meet their organic growth goals, bank managers should move in the other direction and encourage lenders to tighten pricing and lending standards, increase debt service coverage ratios, and move away from their least creditworthy borrowers. While lower loan volumes may reduce earnings in the near term, avoiding risk today could pay dividends further down the road and help banks minimize credit losses. The approach could also help institutions to improve their funding bases, which represent the true value of a banking franchise. Slower loan growth would reduce a bank's funding need and allow for quicker reductions in deposit costs. Banks are already benefiting from the remixing of their balance sheets as higher cost certificates of deposit CDs roll off their books, but the pace of improvement could be even more pronounced. A stronger funding base and continued strength in credit quality would be rewarded by investors and appeal to potential acquirers. Banks that are willing to take steps back to operate more cautiously now will also have a greater opportunity to continue growing both organically and through acquisition when the next downturn occurs. So I think there's a lot of good points made here in this article. However, I would just say, I think one of the biggest issues in loan growth has been the Fed's non-willingness to reduce the interest rates. I think if the Fed dropped rates by just 100 basis points, if they just came down 100 basis points, so if we went from 4.5% Fed funds rate to 3.5% Fed funds rate, that would drop rates at commercial banks back into the fives. I think if they did that, I have no doubt that there is a tremendous amount of pent-up demand right now for a lot of people that want to be out there doing things, but they're just not doing it because of how high the rates are. Now, you could say historically that rates are not high by historical measures, and that is true. However, that's not where we've been for the better part of the last 15 to 20 years. People psychologically have been geared to ultra low rates. So even these modest increase to rates up to 6-7% have really hit people with a shock. And furthermore, the numbers on the deals have been geared toward rates at 3.5%, 4%, 4.5%. That's where, especially particularly investment deals with non-owner occupied commercial real estate properties, that's where all the numbers have been built around interest rates at that level. So you just bring interest rates up 3%, now 6.5%, 7%, and all of a sudden, all those deals that worked before, they don't work anymore. So, but if you can bring it down just a point, I think that gives enough breathing room. I think the market could find enough of an equilibrium, and there's certainly enough pent-up demand that I think you would dramatically see borrowing start to come back very nicely. But some of the points of the article are well heeled here. Going back to the first article, we do see this slight rise in bankruptcy filings, and there are some concerns here. Obviously, the tariff issue out there is still there. Inflation's not fully gone away yet. I think it's a great thing, and we could be seeing a turning of the credit cycle. So again, this is just very important for, I think, banks to keep this in mind. And the last note I will say here is that, your sales teams, it's not so easy. You can't just turn them on and off like a light switch. It does not work like that. As particularly on the commercial side of a bank, your sales lead time it could be years. I mean, you could be working prospects. You could be waiting a year or two for their loan to mature, to reach maturity. You could be waiting for a project to get approved so they could finally come in and say, all right, we got our approvals, we got our land development plans ready to go, so we're finally able to put a shovel in the ground. You could be waiting, a couple years for that to get to for a project to get to that point. I mean, so there could be long lead times and just waiting for certain deals to materialize and certain things to come in. It is not an instant thing, and you can't just all of a sudden one day say, yep, you know what, guys, we're just not lending. Just stop doing that right now. We'll wait 6 months and then we'll come back to it. All your customers that had are relying on you and waiting on you and everything, all of a sudden you're going to tell them, hey, yeah, we're just not doing anything right now. Come back to us in a little while. That's not going to work for them. That's not going to work for them. They're going to go somewhere else. So you have to keep these things in mind. So you have to be cognizant of, keeping the organic loan growth going, but at the same time being mindful of the turning of a potential credit cycle, of making sure that your loan loss reserves are appropriately where they should be, and that you are watching your credit underwriting, cash flow levels, like what's, just is everything working the way that it should? And if you're seeing some ticks in certain aspects of your loan portfolio, you should be taking a harder look at some of those and that kind of thing. So, but again, overall, I thought that these were some good articles that really pointed out some things that banks, should be concerned about, a potential turning in the credit cycle. Keep an eye on that. And if it does potentially have turn, just make sure that you're well positioned to be able to handle that. That's all. So, but again, interesting things here. And if anybody would like to see these articles, there is a link to them in the description down below. So with that, I will wrap up by saying if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, at Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, please check out some of the other content on the channel. With that being said, I thank you for listening. I hope you have a great day out there, and I will see everyone again real soon. Thanks a lot.